Are things as steady as they appear in Switzerland, as unemployment rate data showed no change from last month? Looking at this and more data coming out of the country, I'm joined by Alexis Bill Körber, Senior Economist with BAK Basel Economics. So Alexis, not much movement today in regards to the Switzerland unemployment rate, staying at 3.2% in September. Are things as steady as they appear, or is there more to this data than meets the eye?
If you adjust for seasonal factors, there was a movement from 3.3 to 3.4%, and one has to take notice that since the exchange rate shock set in, there has been a not too pronounced but steady increase of around 1,200 people per month to the unemployment market. But nevertheless, and that's the good news, this trend has weakened somewhat since July, May already influenced by the weakened tendencies of the franc. And one evidence we have for that is that unemployment stayed below expectations in the tourism sector, which is very exposed to the franc. But we don't guess anyway that the worst is over yet. Uncertainty among companies is still high, and many companies have announced job cuts for the future, which haven't went fully in yet. And all in all, we expect that unemployment rate will rise to around 3.7% until the end of 2016.
Also keeping steady, the Swiss inflation rate keeping at negative 1.4% in data out on Tuesday. Franc appreciation, lower commodity prices and slack in the economy all conspire to keep inflation soft. Should we expect inflation to turn positive anytime soon?
No. Even with the impact of the lower fuel prices fading out next year, we expect inflation to decline around 0.3% for the average of 2016, and that's due to the capacity utilization below its long-term average, and of course it's in line with the expected weakened tendencies on the labor market.
Switzerland had been looking to September for the Federal Reserve to raise interest rates to ease economic pressures, which, as we know, the Fed held off on. Now that there are talks that the Fed may wait until next year to raise rates, what does this mean for Switzerland and the franc?
At first, we guess it means that S&B rates remain at their current negative levels at least until the beginning of 2017. But we don't expect also further interventions of the S&B, as the global economy should gather pace during 2016, which should also lower the need for the Swiss franc as a safe haven. And one also has to keep in mind that investors are already scared by the negative interest rates. And in our baseline, we still expect that the franc will move to around 1.15 per euro at the end of 2016. Staying for some months around 1.09 as its current levels, but at the end of 2016 we guess we will see around 1.15. But of course, if one of the high global risks we still have is going to realize, e.g. a more pronounced decline in the emerging markets or a renewed Greece crisis, it will also renew the pressure on the Swiss franc, and we could easily see a much stronger franc than we expect.
Well, that's all from Alexis and myself for now, but do make sure you keep tuning in to Dukascopy TV for more updates, news and analysis like this. Bye for now.